Hello, chart watchers, and welcome to this Wednesday, November 28th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, Fed Chairman Jerome Powell about to start his speech. And the Dow Jones Industrial Average currently at the high of the day, up 257 points. The S&P 500 up 18. The NASDAQ up 49. Russell 2000 was lagging earlier, but it has now moved into positive territory, currently up nearly 10 points. 10-year Treasury yield relatively flat today, still kind of sitting around that 3.06% area. Volatility index continues to drift a little bit lower, down around 19. I continue to watch that 16, 17 area for support. If we break below that, certainly would begin to point to a correction rather than a bear market, but we'll continue to watch that. XLK Technology leading the action today, which is welcome relief. Yesterday, we saw mostly leadership from the defensive areas, but we are seeing technology lead today. Software having a really strong day, moving back above a key moving average. One of the reasons, Salesforce.com came out with a report, pretty strong, beating on top line, bottom line, and raising guidance in a couple of areas. But you can see Salesforce up about $6.75 today. Healthcare also strong. And riding the heels of the healthcare providers index, which is not too far from breaking out. This group has continued to be very strong on a relative basis, and today you can see it up more than 2%. On the flip side, Facebook. Facebook has continued to move lower. Communication services, internet stocks, and of course, Facebook being one of the giants in that space, just not able really to get a bid here. But Facebook down despite overall bullishness in the overall market. Okay, Erin, it's hump day. We're getting ready. It's hard to believe, almost into December. I mean, 2018 is almost gone.
I know, it's crazy. And I know that, with this month ending, there's so much going on those monthly charts right now, too. So I'm going to be looking forward to going over all of those on Friday. But, in the meantime, I'm waiting. There's so many sell signals showing up on the PMO on my monthly charts. It's one thing to show up on a weekly chart, but when it starts showing up on the monthly chart, that's when I get really concerned.
Well, and I think most technicians would agree that the longer-term charts are more meaningful than short-term. I mean, obviously, I'm a fairly short-term trader, so I focus mostly on the short-term charts, but the long-term charts are very important in giving you an idea of the direction on whether or not a stock or an index is trending higher or lower over a longer period of time. So, I know that those monthly decision point reports are very important in what you do, and they will be changing here in just a couple of days.
Indeed.
All right, we got a special guest here with us today. Marc Chaikin is back with us. It's been a while, Marc, but welcome back to Market Watchers Live.
Tom, it's great to be here. Erin, good to be with you.
Yeah, I know you're going to be talking about some of these technology stocks and some of the other, the areas of the market and what you're looking at in terms of the market. And we're going to try and get through everything else quickly so we can get back to you, but maybe about 15 minutes or so, if you'll stick around. I'm sure everybody would like to hear what you're thinking about this market.
Can't wait.
I can't wait to hear it. You've been pretty much right on. I know Dan's come in here quite a bit as well. And I'm not going to spill any news here. I'm going to let everybody wait to hear, but it's going to be an exciting report from Marc. And that'll be in about 15 minutes. So, Erin, if you want to take it away, the schedule and today's agenda, let's do it.
By the way, guys, Erin, I'm watching CNBC on mute, and Jerome Powell did not throw a monkey wrench into the mix here. The market has continued to rally even after the synopsis of his comments by Steve Leisman on CNBC. So far, so good. Who knows what he'll say in the Q&A, but I think he's been coached to, not take away the keg from the party here.
Yeah, a little too soon.
Live update. That was awesome. Thank you, Marc.
Yes, thank you for that. Yeah, it'll be interesting to see in our final market update later what's been going on. All right, so upcoming schedule, December seasonality report, and that is coming up tomorrow. I can't wait to see that, Tom. What's hot, what's not? Mary Ellen will be in on Friday co-hosting for me. And I will have a workshop for you next week on Tuesday. I'm not sure exactly what I'm going to do it on, but we'll see. And then Gaddis Rose is going to join us on Wednesday. We haven't had Gaddis on the show in quite some time, so that'll be great. Today, though, what are we going to do? Well, first of all, we do have Marc Chaikin here, and he does have a great presentation for us. So after technical news, we'll be bringing him back in. 10 and 10 to 1. Our first symbol is going to be CREE, C-R-E-E, if you want to go take a look at that chart and do your own annotations. And then the scooter report is going to finish off. Tom and I will give you the latest on the StockCharts technical ranks. All right, Tom, take it away. Technical news and headlines.
All right. Well, first, let's start with the economic reports. This morning, we got the Q3 GDP second estimate, 3.5%. That's exactly what the market was looking for. So no major problems there. October wholesale inventories came in a little higher than expected. They rose 0.7% versus 0.4 expected. October new home sales, though, did come in quite a bit below expectations, 544,000 versus 575,000. We have seen a lot of bad news out of the home construction, home building area throughout 2018. Recently, though, they've been trying to maybe put in a bottom. So I think sometimes it's really important to see how the market reacts to news that is not so good, because if it doesn't react too negatively and you hold on to support, many times that could essentially in the longer term put in a bottom. We'll have to wait to see. And as Mark just mentioned, Fed Chairman Powell speaking at noon today, sounds like he didn't have anything terrible to say based on the fact that the market is rallying after his comments. Let's take a look at the 10-year Treasury yield and see what's going on there. I have not updated this for a minute or two, so I want to make sure I get the latest here, see what the bond market is doing. Still hasn't really changed, though, much. Still 3.05%. Down slightly from where we had closed yesterday. I still think the overall uptrend in the 10-year Treasury yield remains in play. If we go back and look at the 3-year weekly chart, I think it's pretty clear we have a nice uptrend in play. And you might say, well, this isn't nice because higher rates, could kill the economy. And I would say not at this level. I think historically, it's been proven that interest rates in the 3% area for the 10-year Treasury yield that's historically low. And I think even moving up, I'm going to say to 4.25%, I don't think would be horrible. In fact, that kind of movement to the 10-year Treasury in the Treasury yield would suggest money is rotating out of Treasuries, likely because of strengthening economic conditions. And I think that money would find its way into U.S. equities. So let's continue to watch it. We don't want the yield surging to the upside, but this slow and steady move to the upside, in my opinion, is not necessarily a bad thing. We did have a couple of earnings reports out. As I mentioned earlier, Salesforce.com. They came in, beat expectations, as you can see on your screen. Another software company, Nutanix, NTNX, also came in much better than expected on the bottom line. You can see the other companies there that reported pretty strongly for the most part, with exceptions being Tiffanys, which just matched expectations. I think they came up a little weak on their top line as well. And J.M. Smucker missed on their earnings also. Let's take a look at a couple things, though, in my blog this morning. First thing I wanted to take a look at, and that is, this is a chart on the dollar, which has continued to strengthen. And that this primarily, in my opinion, is rising. Well, it's actually rising for a couple of reasons. I think the fact that the U.S. stock market's been so weak and global markets have been so weak, I think sometimes you see money rotating into the dollar for safety. But I think also it's because our economy has been much stronger than other foreign economies. We've seen that. One of the charts that I show sometimes is the 10-year Treasury yield here in the U.S. relative to the 10-year Treasury yield in Germany. And that has been going up for quite some time. And throughout that period, the dollar has been going up. And I think that makes sense to me. So what effect does this rising dollar have? Well, one problem is that typically it sends gold lower. There's a pretty strong inverse relationship between the dollar and gold. And we had that relationship until the beginning of October. So for the most part, the dollar was rising, gold was going down. And if you look at gold relative to the S&P, it was going down. But the last 2 months we've seen, and I know Erin's talked about this quite a bit, it's almost like the two have kind of decoupled in terms of that inverse relationship. And the dollar's continued moving higher, but gold has held up okay along with gold versus the S&P. Now, my theory on this is that there's a lot of fear in the market. And anytime you've got fear, you've got money that rotates into gold. And at the same time, we're seeing it also rotate into the dollar. I don't think this is going to last, though. I think it will eventually turn back lower on gold. I think the dollar continues to strengthen, and that's just my opinion. And I went another step further, and I looked at the dollar chart over the last 20 years. So this is a 20-year weekly chart on the dollar. And you can see the impact that this has on commodity stocks. And in particular, I looked at the XLB, material sector, relative to the S&P. During the last bull market, from 2000, well, really 2003 was when the bull market started, but from 2001 to 2008, we saw very strong relative performance in materials. And that was accompanied by a drop throughout that period in the dollar. A lot of folks looking at this market are wondering why commodities aren't performing well. Well, since 2011, we've seen the dollar going straight up. I mean, we had the dollar index down around 73 in 2011. Now we're at 97 and change. And so during this period, the XLB on a relative basis has been dropping. Now, I mentioned in my article, materials haven't gone down. They've gone up. They've gone up from under $15 back in 2009 on the XLB to a close yesterday at 53.26. But what's going down is their relative strength. So there are other areas of the market that are performing a lot better. And one of the big headwinds for materials currently, and I think are probably going to continue, at least in the foreseeable future, is that the dollar continues to rise. And I think that is continuing to put a lot of pressure on the XLB. All right, let's go back and take a look at a couple of these earnings, companies that reported earnings. The first one being Salesforce.com, CRM. And I talked about this in Earnings Spotlight back on Monday, some of these stocks. And this one, I would say, you know, when I looked at the relative chart, I was a little nervous about Salesforce.com because the stock was pretty strong up until October 1st. And you can see its relative strength relative to software was very strong. And then all of a sudden fell apart in the last 6 weeks or 8 weeks. And I know the group fell, but this is relative to the group. So it's actually been a very poor performer within the software space. They did get the big gap up. They cleared that 20-day moving average. So I think we might have a change in character here with Salesforce.com. And this has been one of the leaders in the past. So this is certainly something that I would keep a close eye on. But at least in the near term, things appear to be improving here for CRM. Another one in this space, NTNX. You can see on a relative basis, this one had been lagging for a while. This report was pretty darn good. They beat on their top line, beat on the bottom line by a wide margin, but they only provided inline guidance going forward. So there was no raised guidance. Stock did gap up, but I think it's trading in just this range between gap resistance, probably around 46.5 or so, and this double bottom down around 36. So that would be the range. We gapped up, but we've been selling off a little bit since. A little bit more mixed picture, I think, technically on NTNX. Royal Bank of Canada. Nice move here on the stock after earnings came out. Another change in character, it appears to me, after struggling to get through the 20-day moving average. We have gapped up. They did beat on the bottom line $1.71 versus $1.61. And at least in the short term, starting to show some bullish characteristics. Tiffanys. Tiffanys we talked about and didn't like it, if you recall. The stock had topped back in July, even though the specialty retailers went back up and equaled their high back at the end of September. You can see on a relative basis, Tiffanys was already declining. And on a relative, when you look at Tiffanys versus specialty retailers, it had been on the move lower for the past few months. Tiffanys relative to the S&P had been declining. And the overall group versus the S&P had just kind of been, going along for the ride, but nothing more. And so I speculated Tiffanys was going to come out with a report that might not be so great. They did miss on their top line. They matched expectations on their bottom line, but they only reaffirmed their fiscal year 19 guidance, and they lowered their fiscal year 19 comp guidance. And as a result, you can see the stock down almost 12% today. Now, Burlington, BURL, another company that reported beat on the top line, beat on the bottom line, kind of had some mixed guidance, but this is one that we had speculated might not be so bad because it was trading really close to its relative high versus the apparel retailers. And I think on a relative basis was looking pretty good. Now the report comes out. Look at the volume coming in. Very, very strong move here today on Burlington. This too is in a trading range, but I think off of this uptrend, I think this is a pretty bullish pattern. I like Burlington. All right, Erin, I know you got a couple of or a few upgrades, downgrades. Why don't you take it away? What you got?
All righty, let's take a peek. Give me a second here. All right. So today's upgrades and downgrades, there were medium amount, I'll say today. The first upgrades I'm going to go over, DaVita, DVA. This one was upgraded by Raymond James from a market perform to an outperform. I thought the interesting part of this chart is this area of resistance. It lines up here with what we saw as a low in October, but I'm also seeing it as the top of a consolidation zone and lining up with a previous gap all the way back in last December. But the main thing I want to point out is the PMO is turned up. It was already turning up with the rally over the last 2 days. And now we have a breakout above that $64 level, which, like I've shown you, I think was a pretty important place. You've got the scooter rising, and OBV volume still looks pretty good as well. Spirit Airlines was upgraded today by JP Morgan from a neutral to an overweight. I opted to put this on a weekly chart for you. Let's see. That's not looking right. All right. So yeah, I decided to put it on a weekly chart for you. And as you can see, we have a breakout above that $60 level. That's very important. Now, of course, so far trading this week, you've got Spirit Airlines up almost 20% on the week. So sadly, we might be looking at chasing if we have to get in here. But the important thing I wanted to note was that this is a really important breakout above these 2016, 2017 tops. We're now hitting a price level that we have not seen since back in 2015. So Spirit Airlines looking really good on the upgrade. A couple of other big name upgrades that I'm not going to go over, but Skyworks, SWKS was upgraded, and On Deck Capital, ONDK, was also upgraded as far as others you might recognize. Let's go ahead and look at some downgrades right now. Beacon Roofing Supply, BECN. This one was downgraded from a buy to a neutral. I thought this chart looked really interesting. You know, you've got what I would say is a flag forming here. Look at this in the thumbnail. It's pretty textbook looking. And it's now coming up off of this decline. So it's a nice reversal pattern, I would say, that we're looking at right now. The PMO is not quite in positive territory, but you can see we were on a buy signal back in earlier November. Didn't pan out to be very much, but now we're finally seeing some action. If this is a flag formation and it does execute, the minimum upside target would be about the length of the pattern. So let's say a little under $10, which should give us a move up into the $33 range, I guess, or $43 range, somewhere in there. So definitely going to test that 42.50 overhead resistance if this executes as a flag. Whirlpool was downgraded today. WHR by Credit Suisse from an outperform to a neutral. It's been on a really nice run at this point, so it's sort of interesting to see that this one was downgraded. You know, the PMO is looking great. You might say it looks overbought, but if you look the PMO oscillates between, looks like in this case, I haven't pulled up the history, but -3 to -4 to +3 or 4. So a reading of 2.25 isn't that much for the PMO, and I wouldn't consider it overbought. Getting ready to test some overhead resistance here, though, I would say at these August top, the August high we saw here at about $130. So that would be the level I'd be watching. And finally, YY Incorporated was downgraded today by JP Morgan from an overweight to a neutral. I did not get a chance to annotate it, but there might be some possibility here with a ascending triangle, and that formation is bullish, and that would tell us to expect a breakout above that $70 level. I do have a caution here, though, because I am seeing a PMO top below the signal line, and typically that's bad news. But if we can see it turn back up and maybe get into positive territory, could be interesting. I might put it on a watch list just to see what happens at that $70 level. That's all I had for upgrades and downgrades. Here is the listing. Other downgrades I didn't show the charts for. CME Group was downgraded. Cracker Barrel, and I think you were talking about that, Tom, yesterday at one point. And in Encana, ECA were was also downgraded. All right, so that's all I had there. And there you go with what we are looking at, what I looked at, what I didn't. All right, Mark, time to bring you back in. Very excited to hear what you have to say, because I know there are a lot of concerns about what's going on in the market. I would have to tell everybody, if you haven't already and you are watching live, to go take the poll, because I know Mark would really appreciate seeing your thoughts on the market right now.
Oh, that's great, Erin and Tom, and we've got some really exciting stuff to share, and let's get to it.
I know we were talking just a couple of minutes before the show started, Mark, and I didn't want to spill the beans earlier, but you're kind of bullish here.
I am. These charts were obviously done before the Powell speech and reflect, some thinking that we've been communicating with our subscribers for the last month or so. And we're going to walk pretty extensively through why we feel the way we do about the market, and definitely bullish here, and happy to see that there's some breakout potential above 2,700 developing in the S&P.
Awesome. Take it away.
Okay, so today's presentation is all about combining fundamentals with technicals to improve your trading and your investment performance. Obviously, if you're using StockCharts.com, as I've been since Chip Anderson rolled out the platform probably 20 years ago, you've got the best technical platform in the world, and they keep improving it. What we're going to talk about today is how I have succeeded and survived 50 years on Wall Street by using technical analysis, but always in conjunction with fundamentals. I realized early on that fundamentals drove the market, but you needed technicals to survive bear markets. I've lived through 10 of them. I can tell you that this is not a bear market because so many people are bearish. From Jim Cramer, my good friend, to the analysts at Morgan Stanley, Merrill Lynch, and Goldman Sachs. I've never seen a bear market develop when everybody is calling for it on CNBC, and it's a contrary way to look at things, but the crowd is always wrong, even when the crowd are the experts. So what today's presentation is about is our way to look at the fundamentals, because that's time consuming, requires some expertise, and you've got 5,000 stocks out there, and some of the stocks that had earnings upgrades and downgrades today, like Beacon, are not that well known. So you need a way to objectively know what the fundamental potential for a stock is. And based on working with institutional investors for over 30 years, I created the Chaikin Power Gauge rating in 2010, and it's really the culmination of my life's work. I went way beyond technical analysis. I know many of you are familiar with Chaikin Money Flow. Just yesterday, Jeffrey Sout, who's the chief strategist at Raymond James, was quoted as being extremely bullish on the market, and he said money flow is improving, and lo and behold, there was a StockCharts chart with Chaikin Money Flow on it. So I wanted to go way beyond that and build what was reflective of what successful buy-side portfolio managers with different styles and time horizons had been doing for over 30 years. And I work with them selling technical analysis tools, Chaikin Money Flow and relative strength, but I was able to draw upon everything I learned from them. They were mentors to me to create the Chaikin Power Gauge rating. But before we do that, as Tom said, I want to take a look at the market, because this has been a very difficult, challenging, and painful period for a lot of people. We went in early January from an uptrend on autopilot in 2017 to a roller coaster of a correction. And Tom, when we were talking earlier, you talked about the February double bottom in 2018, February-March double bottom. I was actually on Market Watchers Live for the first time in late February, when we were right up here at that rally point at 2,800. And on that presentation, I talked about the need to come back down and test those lows. Intraday low was 25.30 back then. Closing low was around 25.80. So we formed a W bottom. Now we're going to talk about when you see V-shaped bottoms and when you see W bottoms. But what happened after this W-shaped bottom is that you went back to an uptrend on autopilot. It was pretty much straight up from March through September. And then we had a big wave down. There's no other way to express it. We just selling fed upon itself. Now, there's some interesting reasons why that may have happened. ETFs have become very prominent. You have the SPY, which we're going to look at in a minute. We're actually looking at it now, 1-year chart of the SPY and Chaikin Analytics. And a lot of money is in this, $240 billion roughly, even after a big correction. And that money is in cap-weighted stocks, Apple, Facebook, Netflix, Google, and the like, because it's a cap-weighted index. So where are we now in the market? Well, we had this big wave down, panic selling down to 2,600 intraday. We didn't close below 2650. Now, why is 2650 important? Because that represented a 10% correction in the S&P 500. So we rallied up twice to 2800. That's your expected resistance level, actually closed above it, but we never tested that bottom. Now, just Friday a week ago, we came back down, closed under 2650. So that means you're not in a pullback, you're in a correction. And I'm going to show you in a minute why that's important. And look at Chaikin money flow. Chaikin money flow down here was actually positive when you came back down and got oversold. And that's the pattern we're going to look at very intensively in this presentation, because it's something you can do in stock charts. But we've been teaching this pattern for institutions for over 30 years. Now, we now have a power gauge rating for ETFs that combines fundamentals with technicals. So the power gauge rating on the SPY is bullish, and it has been bullish except for this neutral period as we were forming what I believe is a W pattern. And today's move up in the face of the Jerome Powell speech, where everybody was nervous that he would talk about continuing the interest rate hike cycle, which is clearly weighing heavily on people. But as Tom said, interest rates that go up because the economy is strong are actually bullish, not bearish. JP Morgan, Tom, did a study, published it about 4 months ago, that until the 10-year Treasury gets to 5%, it doesn't really have an impact on the economy. And that's, I think, where we are right now. So I believe that we're forming a W. If we break through 2810 on a closing basis, guess what? Reverse head and shoulders, and that counts to 3025, which has been our long-standing target for this bull market. So I think that's the potential. We need a catalyst to get there. And I think Jerome Powell, the non-event speech today, is one of the catalysts. Obviously, if we get some positive news on tariffs between the G20 and the talks between China and the US, that would be an even bigger catalyst. So let's put pullbacks into perspective. Since 1945, I'm going to update this on the fly. This chart's about 9 months old. Been 77 declines of between 5 and 10%. We call that a pullback. That's when you typically see V-shaped bottoms, average decline of 6%, take about a month to 2 months, and then you recover to new highs. Where we are now is a little bit odd. There have been 28 declines of between 10 and 20%. We call them corrections. They average about 13%. So 2600 was about 12% down from the high of 2940. They tend to last for 4 months, and then within 3 months, you recover to new highs. I believe we're in that cycle now, even though it's the right side of the W where you got your 10% decline. So right side of the W, usually the left side gives you the 10% decline, as it did in January. So I think that's where we are now. And just to show you that this is not unusual, here's a chart from advisor perspectives that shows you the drawdowns from record closes in this bull market beginning in March of 09. And where the red circles are, these were W-shaped bottoms that happened because the S&P closed down more than 10% from its high. So we had them in 10, 11, we had one in 15 in August, September, and then again in 2016. What was the catalyst in 2016? The market looked like it was going to hell in a handbasket, as my old friend Stan Burge used to say. Well, the catalyst was Jamie Dimon, CEO of JP Morgan, saying, I'm buying $25 million worth of my own stock. Came out of the blue. It was enough to trigger a move to new highs. Any closing decline, even when it approaches 10%, of less than 10%, typically results in a V-shaped bottom. So where are we now? This chart's about a week and a half old. We actually got that 10% closing decline. I believe that given the circumstances, the seasonality and so forth, that we have formed a W bottom. Could we go back down to 2,600? Of course, but I don't think that's going to happen. So the point of this chart is there's nothing new going on. Corrections are painful when you're living through them, but they're opportunities, and we're going to look at how you take advantage of them. So here's something from StockCharts that I look at every week. These are the number of stocks making new 52-week lows in the S&P 500, and they typically spike at the first bottom, and that's what happened back in February of 16, and then again in January of 18. And then you get a bullish divergence at the bottom, and that's what we've seen here, because you can see that we form this W pattern. And look at this, the percentage of stocks making new lows was almost non-existent. And so we've got a really bullish divergence forming. And another indicator that I look at is put call volumes. And here we have a chart that goes back to 2001, courtesy of the Options Clearing Corporation. Heavy put buyers by small traders in the last 2 weeks. This is an 8-week sort of moving average. The same condition existed at the bottom in 2002 and 2008. You might say, well, those were bear markets. Well, if you believe the people on CNBC, we're in a bear market. So here's a very bullish contrary indicator. Small traders have been hedging a lot. And even back here in 15, 16, you can see the spike. So it's a contrary indicator, and it encourages me to be bullish. We've been seeing this pattern now for a couple of weeks. So what should you focus on in 2019? Well, trend of corporate earnings. Third quarter earnings were great. We expect fourth quarter earnings, when they start coming out in January, to be fabulous. Tax cut helped. Guess what? We've had a new tax cut here in the last 3 months for the consumer. Crude oil making new lows, price of gas at the pump down. Tom talked about commodities going down. That's another reason why Jerome Powell can pull back on the rate hikes, because his favorite inflation indicator, PCE, personal consumption expenditures, is going to dip below 2% because commodity prices, particularly gasoline at the pump, are dropping so sharply. So we could have a very, very good earnings environment in 2019, up maybe 8 to 9% year over year. Interest rates are obviously important, but I think the market has been fixating on that. Sector and group strength and weakness, really critical. Now, recently, the defensive sectors have been strong: consumer staples, utilities, healthcare, real estate. That's unusual when interest rates are rising, but it is the reality. I think that tech and finance are going to take over again, along with consumer discretionary and stock selection. So the rest of this presentation is all about stock selection. What's our scenario? Higher rates and rising earnings. It's a very bullish scenario for 18 heading into 19. Now, just to put a point on it, economic downturns precede recessions and bear markets. So I look at 4 indicators, including the yield curve and unemployment. I've highlighted 2 of them here: leading indicators versus coincident indicators from the Conference Board. They've always turned down before every recession since 1960. You can see that on the chart, making new highs as we speak. And even though housing numbers have been weak, the 12-month moving average of housing starts is still rising. There's a demand for housing under the surface. Higher interest rates and higher prices and unavailability are diminishing, but housing starts are going up, and they've turned down before every recession since 1960 as well. So, hey, Mark, yeah, sure, Tom.
I got a question for you, because this is kind of pretty timely. I mentioned earlier that housing starts new home sales came in huge disappointment this morning. And I'm looking at the home construction index, which went down initially quite a bit, but has now rallied up probably about 4 or 5% off the low from earlier today. And it's now at about a, 7-week high. Do you think, you were just talking about that area. Do you think that home construction stocks, because they've been hit so hard, in 2018 present a nice opportunity going forward? If we are truly strengthening and we still have fairly low interest rates, historically speaking, is that an area that you'd be interested in, or do you need to see more technically out of that group first?
I'm interested, but I need to see more technically. I'd like to see Chaikin money flow turn very positive and stay there, indicating that there's accumulation going on. Also like to see this pattern that you define with Scooter, that we define with our bullish personality changes. Like to see the XHB start outperforming the market. So relative strength and money flow are the two things that I'm going to look at to determine whether there's opportunity in home builders.
Awesome. Thank you.
So what's wrong here? If the economy is strong, earnings are strong, what's happened? Well, fear has gripped the market. This is the CNN Fear and Greed Index. Hard to believe, but CNN has constructed one of the most useful sentiment indicators. It was 19 this morning. Extreme fear, it's improving, but you can see for the last month, we've been in that extreme fear zone. Now, why is that? Well, people are afraid about interest rates. They're afraid about tariff wars. But the reality is, for whatever reason, fear has gripped the market. And if you believe in Warren Buffett, investors should be fearful when other people are greedy, and greedy only when other people are fearful. There have been buying opportunities out there. There will continue to be buying opportunities, and we're going to zero in on how you find them. So the problem is what to buy and when to sell, and our solution is Chaikin Analytics. So the charts that we're going to show you are our way to combine fundamentals with technicals. As I said in the beginning, I've always believed that fundamentals drive the market, but emotions drive the market to extremes. And what better gauge of emotion than that fear and greed index? So for me, the path to profits has always been to combine fundamentals with technicals. And the way we do the fundamental analysis is the Chaikin Power Gauge rating. That's the culmination of my life's work. Very simple display, but a lot of number crunching going on under the surface. And now we have a rating for all equity ETFs that combines fundamentals, the underlying stocks in those ETFs, with technical analysis, a combination of relative strength and momentum. So you can see a lot of that on StockCharts with the RR charts, but we really believe in the power gauge and how it can help traders and investors who are technically oriented. So the Chaikin Power Gauge rating cuts through the clutter of all those economic numbers on the right and fundamental data, and gives you the rating on the left. In this case, Starbucks, which has had a bearish rating in our model, turned bullish. And we'll show you a chart of that in StockCharts to see how you could have identified that shift in relative strength. But for components, earnings, technicals, and experts are bullish. The financials, not so. It's a melting pot, so they don't all have to be bullish. But the key is that we're looking at a variety of factors: value, growth, technicals, and sentiment. So this isn't a religious model. It doesn't say I only buy value stocks or dividend-paying stocks or GARP stocks. It's eclectic. It finds a lot of ways to like or not like a stock. And these factors are what successful institutional investors look at every day, but they all have different styles and different time horizons. So value investors look at free cash flow and price to sales. Jim Cramer, a growth advocate, looks at earnings growth, earnings surprise, consistency, and so forth. We think sentiment indicators are really critical. They're our secret sauce. Earnings estimate revisions, very important. Short interest, insider activity, particularly in small caps. If insiders are buying, that's a big, big tell. And industry group relative strength. We love to stay with strong industry groups. That's why we're going to wait to see if the home building ETF starts to pick up relative to the market. Now, a little bit of performance, because I want you to come away believing that there is a way to know what the fundamental potential is without having to do 2 to 4 hours of work every day. Power gauge rating using the Russell 3000, average annual return since 1999 for very bullish stocks, up 20% a year. Average very bearish stocks up only 1%, and that's after a 9-year bull market. Part of the results through 2011 are simulated. Everything from 2011 is real time. So in 2015, we had a bear market in energy stocks. In the middle of this great bull market, energy stocks took it on the chin. And so the average very bearish stock in the power gauge rating, these were the Kinder Morgans and Range Resources and Pioneer Development of the world, were down almost 18%. Small caps in general were in their own bear market. The Russell 2000 was down 28% at one point in 2015. So it was very important to know which stocks had bullish ratings and to avoid the stocks with very bearish ratings. Now, a little bit of a endorsement from my friend Jim Cramer. We just did a 1-hour one-on-one webinar. I want to explain why I love Marc Chaikin stuff. It's simple, it's understandable, it's rational, it's not emotional. And you know I use it constantly, almost never want to go against it. High praise. Take exception to Jim's bearishness on CNBC recently. Don't know exactly why. We haven't talked about it. We texted after the Eagles game because that was his obsession and always is. And it's validation because Jim uses a lot of sources, technical and fundamental. So if it's good for Jim, I think it's good for a lot of people as well. I'm going to start with a generic classic pattern and then zero in on two very unique patterns using Chaikin money flow and Chaikin relative strength, which you can find on stock charts. So classic bull, these are the stocks that get you the big performance in your 401k plans. They're the stocks you want to trade from the long side. Power gauge is bullish, so the fundamental potential is strong, outperforming the market. And Chaikin money flow is strong, telling you that the institutions are accumulating the stock, because that's what it's measured and has since 1982 when we introduced it. So we read the chart from the bottom up. And the reason is the power gauge rating is a ribbon at the bottom of that chart that goes from red to green to yellow. So power gauge rating for Cigna over the last year, 2 patches of green as the stock made 2 new highs up at the 220 level. Then we look at the relative strength. Now, this is our way of looking at what StockCharts does with Scooter. It looks back over 26 weeks. It's like a stochastic of relative strength. So it's a little more sensitive than Scooter, but it accomplishes the same thing. So here we see that the relative strength went from red to green. We try and make it really simple, color code it. So you had what we call a bullish personality change, and then Chaikin money flow all the way up for Cigna when it broke out of this base at the 180 level on its way to 220. Institutions accumulating, and then buy and sell signals. Really important to have a disciplined approach to exits and entries. We're going to show you a couple. This is our oversold buy. I owe this one to Larry Williams. Stock that you like, and we define like as power gauge bullish, makes a new 8-day low as it gets oversold. Pattern works about 2/3 of the time. It's a great entry for swing traders or options traders. Has a time duration of about 5 to 10 days. So it has a short duration, short shelf life. Now, the opposite, classic Chaikin bears, so we're going to look at some examples of that in the recent market activity. Power gauge is bearish, underperforming the market. Chaikin money flow is red, not green, telling you that the institutions are selling. We're using Wynn Resorts as our poster child. Previously, we've had Chipotle, we've had Under Armour, we've had Kinder Morgan on the webinars that we do. These stocks tend to persist for 6 to 12 months, so we keep them in the deck. So looking at the chart from the bottom up, power gauge for Wynn has been bearish, underperforming the market beginning in June. Institution selling, you're looking for sell signals to get out of a stale long position, or more importantly, to put on a put position. We like vertical put spreads. You may want to buy the put outright. But if you get a signal, disciplined entry always works better than trading on your gut, even though our president tells us that he likes to make decisions on his gut. When you're trading, that's a bad idea. So put it all into a pyramid. Power gauge at the top, along with industry group strength, just 2 technical indicators, Chaikin money flow and relative strength. And in the middle, some form of discipline buy and sell signals. Can be candles, can be the PPO, can be anything that works over time that's discipline, and because successful trading demands discipline. So now one of the 2 patterns that we're going to focus on for the rest of the presentation. We call this the secret sell signal that 95% of traders don't see. It's a bearish Chaikin money flow sell alert. Now, there's a lot of documentation on Chaikin money flow on StockCharts and other places. Nobody's ever documented this because we only talk about it on these special webinars. So what is it? Well, it's a stock like Mohawk in the home furnishings industry, same as Whirlpool, downgraded today. They're a little late to the party, I think. And they're affected by home building trends. So Chaikin money flow sell alert happens when a stock gets overbought, and Chaikin money flow, which normally fluctuates around the zero line, stays red or negative. So we see one there. We see another one here. And they were accompanied by what we call our relative strength sell signals. But the big one came up there when the stock was making a new all-time high at 280. Money flow stayed negative. That tells you that smart money is getting out of that stock. Could be insiders, could be institutions. Somebody felt they knew something. They didn't participate in the rally. They sold into it. So this signal, I think, is the most powerful signal I know for traders. So I'm going to just spend a minute on it. Relative strength sell signal. Stock is underperforming the market. So in the case of StockCharts, Scooter would be below 10. Rallies up and gets overbought on a short-term basis, might go above its 21-day average. When it drops below the 21-day average, that triggers a relative strength sell signal. Now, those signals are really powerful. They last 4 to 8 weeks, so you can establish a position and not worry that the option is going to expire worthless in 10 days. And they're 70% accurate based on our back testing. Really powerful signal. You can find that signal on StockCharts by looking for stocks with their scooters under 10 that get overbought, let's say on a 13-day commodity channel index or stochastic or RSI, whatever you like. Now, this is what it looks like on StockCharts. Here's a one-year chart of Mohawk. And we got those two bearish money flow sell alerts. And I use the 13-day CCI, which I've used for, I don't know, 30 years, to measure overbought. We do it a little differently in our product, but you can see that Scooter was down around 10. Stock gets overbought, and institutions are selling, so Chaikin money flow stays red, doesn't go green. And then we had another one right here, and then that big one back there. Now, let's look at a more recent example after we sort of take another quote from Warren Buffett, which is that they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. He says you can wait for your pitch. He calls it the fat pitch. We call it the ideal setup, and the ideal setup requires a disciplined set of entry and exit signals. Now, what we learned in working with subscribers is that a lot of people don't want to go to a website. They want to be told when stocks trigger a signal. So we put an alerts capability into Chaikin. It's very important if you have a discipline to know how to find those stocks that meet your criteria. So we had a sell signal on HFC, Holly Frontier, relative strength sell on November 9th at 65.74. Now, I did a webinar and I was thinking about Thanksgiving and I called it Holly Farms. I was corrected on it. This is Holly Frontier. It's an it's a oil refining stock. And here's what it looked like. It had had a bearish personality change, so it went from outperforming to underperforming. So think Scooter under 10 or around 10. Rallies up, and by the way, bearish money flow sell alert, overbought 65, 75, all the way down to 56. And even with this rally early this morning, still trading 59.25. If you can establish a bearish position or get out of a stale position on patterns like that, you're going to be ahead of the game. So what is a personality change? Just to reiterate, it's a stock that has been outperforming the market that starts to underperform the market. And too often we're stubborn. We don't recognize that. That's why Tom's question about home builders is a good one, because they've been dogs. And if they start to outperform and you're short, you're going to be on the wrong side of that trade. So here's an example of a stock where the power gauge had been very bullish. Applied Materials, along with Lam Research, everybody made a lot of money in 17 on these semiconductor equipment stocks. But something happened in April. You had a bearish personality change, went from outperforming to underperforming with institutions selling. And what we like to do is when you've had a bearish personality change, we don't want to short it or put a put position on right there. We look for the first sell signal. Again, discipline, entries and exits. So that first sell signal was the relative strength sell. It came in May at a price of 50, and the ultimate low on the stock was 30. These are powerful patterns, and you need to spot them. You can do it with Scooter. That's the beauty of StockCharts.com. Now, we also screen for bearish personality changes, so I screen for recent large cap bearish personality changes, and I see that Apple and Amazon and Adobe are on that list. So let's take a look at Apple. First, we'll look at it in stock charts. Stock looked great at 230, but guess what? Bearish money flow sell alert. Why didn't money flow go positive when the stock made a new all-time high, 1.2 trillion valuation? Smart money was selling, Scooter was above 90. There was no indication except from this pattern that's worked for 30 years. We've taught this to institutions. Now we're sharing it with individual traders. So bearish money flow sell alert. And the stock goes into a downtrend, breaks support. Without knowing the fundamentals, you really don't have the complete picture. So here's the complete picture. Again, look at the bottom of the chart. Chaikin power gauge turns bullish at 213 after we had a bearish money flow sell alert, and it has a bearish personality change. Now, Apple is obviously going to rally with the market, but they really got the analyst community upset in their earnings report back in October when they said, we're not going to give any hardware numbers anymore. Well, you do not want to get on the wrong side of Wall Street analysts. And believe it or not, after 50 years on Wall Street, they still have an impact. So that's the reason we like combining fundamentals with technicals. So you can see the technical breakdown. But when you know that an objective multi-factor model has turned bearish, as Apple did at 213 on the way to 170, and you see the technicals break down, then you know what to do. You're going to sell rallies. You're not going to hang on unless you're just a diehard who doesn't like to pay taxes and you bought the stock at 30. But the bottom line is you need to know the complete picture to make the right decision. As you would have in Netflix, here's another one of those FANG stocks where you had a bearish personality change much earlier, along with Facebook, which Tom referred to early on. Netflix had a bearish personality change in July. The power gauge had already turned bearish, and look at the institutional selling. So everything's lined up against it. You get that overbought sell signal, act on it. You get a rally on earnings, doesn't penetrate resistance, act on it. But the bottom line is these patterns repeat over and over and over again. They're reliable. In that webinar I did with Jim Cramer, I was very bearish on Netflix, so I'm there for posterity saying shorted above 320, which is what happened in early November. Now, NVIDIA is a real case in point. This is a stock that captured everybody's imagination. Chips for gaming, chips for Bitcoin, chips for AI, chips for the cloud. Fabulous company, but look what happened. Power gauge turned bearish on October 5th. The stock was 270 down from a high of about 285. So pretty close to the high. That doesn't always happen. Institutions are selling, bearish personality change. So that's where the power gauge turned bearish. Then look what happened. One of the most esteemed research firms on Wall Street, Goldman Sachs, upgraded NVIDIA to a conviction buy at 240 on October 18th. 13 days after the power gauge turned bearish. So are you going to listen to Goldman Sachs, or are you going to follow an objective model? Don't know what the analyst biases are at Goldman Sachs, but what I can tell you is when a stock goes from 240 to 138 and you have a conviction buy on it, something's wrong. They actually reverse that conviction buy down here around 180. But that's pretty painful for people who are following Goldman Sachs research, and the major institutions do that. So Tom talked about Tiffany. I know on Monday he was bearish on the stock, but let's look at it through the lens of the power gauge rating. Power gauge rating has been bearish since August. Bearish personality change, so now the market agrees with the model. Institutions selling. We got our money flow sell signal here at about 110. And then you get a bearish earnings surprise, and the stock's down 11 or 12%. Gap down on the opening, no chance to get out if you hadn't sold previously.
Hey, Mark.
And sure.
I got a question. So on this particular stock, I'm looking at the rally that it had maybe back in September. Is the reason why at that overbought area that you would not have been bearish the stock, is it because it's still hanging on to some relative strength?
No, actually, you look at the bearish money flow sell alert. So it got overbought. Clearly, people were liking the specialty retailers and the luxury goods. But I'd be bearish on this stock. I don't like to buck a trend. We've got a long-term trend line there. It's a double smooth 200-day exponential average, and it does a really good job of defining long-term trends. So, you know, it's a mixed bag, but the power gauge at the bottom is telling you, except when people get excited about earnings, emotional, this stock has basically been underperforming. And I was bearish on this stock, and the bearish money flow sell alert crops up over and over again. Here's another example of it. Institution selling, you can't withstand that tsunami. It's just overpowering. So we also screen for bullish personality changes, and recently Starbucks and CBOE and a couple of the food stocks had bullish personality changes. So let's take a look at Starbucks. Here's Starbucks in StockCharts.com without the fundamental potential of the power gauge rating. But you see Scooter had a big move from under 10 to above 70. The stock actually broke out based on a positive earnings surprise. And what we've seen recently is you've pulled back from about 69.50 all the way to 65. And look at Chaikin money flow. It stayed green on the pullback. That's the opposite of the money flow sell alert. This is stealth buying by institutions. You want to use the oversold as an opportunity to get into Starbucks. Obviously, you're going to use stops, but these are your entry points, and especially in bull markets with stocks like NVIDIA and Micron and the healthcare stocks. By the way, United Health had a great earnings call with analysts last night. That's part of the reason healthcare is doing so well today, Tom. Very powerful. So there's your bullish personality change. You had one in Verizon, which actually was one of those defensive stocks that attracted so much money as people were fearful over the last 2 months. And Tom nailed it. You had a market that should have been doing one thing in October and November because fear had taken over. You had gold going the opposite way. That's probably going to change now that the market feels a little more confident. But there's Verizon, bullish personality change. So we look for that first buy signal as our entry point that came at about 51. High dividend paying stock, rallied above 60, pulled back to the 21-day average here recently with good money flow. These are the stocks that you can find over and over and over again. When the market's defensive, you'll be buying Verizon. When it's on the offense, you're going to be buying United Health and NVIDIA and Micron or Salesforce. So personality changes are really critical to understanding the ebb and flow of money in and out of the market. There's your first buy signal. So I'd like to end the webinar with something completely different. I'm a big Monty Python fan. We have our high-end workstation, but I started Chaikin Analytics to level the playing field for individual investors. So we've introduced something called Power Pulse. I know a lot of StockCharts members have subscribed to Power Pulse based on our previous presentations. It's a way to position your portfolio for success using the power gauge rating. So here's an example of a 6-month chart of Tiffanys through the lens of the chart in Power Pulse. So you see the power gauge and the 4 primary factors. 3 of them are bearish. You see going below the long-term trend where you see that red arrow, we actually put out a sell signal on Tiffanys. I know a lot of you listen to Dan Russo when he does stocks today at 9:15 every day on StockCharts TV between 9:15 and 9:30. Dan has been bearish on Tiffanys, and obviously you had the big down move today. I'll end the webinar with an example of a stock that both Dan Russo and I have been bearish on, Wynn Resorts. You've already seen it as our classic bear. On August 29th, in my weekly market insights, I made Wynn my bearish stock of the week. And here's what it looked like back then. The stock was trading at about 148 on its way to 100. And you can see at the bottom, relative strength is bearish, money flow is bearish, below the long-term trend, but more importantly, the power gauge rating was bearish and remains bearish even with this 12% rally. So that's the way we combine the Chaikin tools into we think, an affordable product that we're going to make more affordable here right at the end. 3 powerful investment tools: personalized portfolio monitoring, our done-for-you research, which includes the power gauge rating, and then my weekly market commentaries, so you can see the vision that I've shared on this webinar. And not right all the time, but right over time, and pretty proud of the track record. So Power Pulse is normally $49.95 a month. As a special for StockCharts users, we're reducing the price to $24.95 a month. This offer expires on Saturday, December 1st. And I'd like to give you a special bonus. If you've followed Dan Russo, you know how sharp he is. He is also the editor of our Mastering the Bear weekly newsletter with a bearish recommendation every week. If you subscribe to this special offer, we'll give you a 1-month complimentary subscription to Dan's weekly Mastering the Bear newsletter. It comes out on Wednesday morning. Very valuable. Even before the market dropped, he really nailed it. And so that's a special bonus. If you subscribe to Chaikin Power Pulse, you'll get 1 month of Mastering the Bear complimentary from us. So with that, I'd like to really thank Tom and Erin. It's always a joy to be on. When I listen to you guys in the beginning, I think, why aren't I that smart? Because you covered all the bases. A lot of the things that I was going to talk about, you nailed. In terms of interest rates, the dollar we didn't go into, but clearly you guys have breadth and depth, and I'm just proud to be part of the StockCharts community.
Well, it is a pleasure to have you on here. That was fascinating, your presentation, and I use a lot of fundamentals along with technicals, and I use the fundamentals to find stocks that I want to trade, and then I use the technicals to find my entry points and my exit points. And so I would clearly endorse what you do with your power gauge. I think it's fascinating that you're able to put into that gauge so many different indicators that are very important in the overall market. And I think I don't know, is this like a post-Cyber Monday special that you've got going through Saturday?
Yeah, now it's Cyber Week now. Cyber Monday is old hat. Now it's Cyber Week, and who knows, it'll be Cyber Month in another couple of years. But yes, this is definitely a Cyber Monday special.
All right, yeah, that is kind of funny though, because it did start out that it was just Black Friday, and now all of a sudden it was Cyber Monday, and now I still keep getting all these emails from everyone saying, we're going to extend this deal. I think we're going to go right up to Christmas on some of these emails I'm getting. But anyway, it's always a pleasure having you on here, Mark. That was some great information.
Thank you, Tom. Thank you, Eric. I look forward to the next time.
All right. I think before you go, though, if we can, our producer, I'm sure, will put up
the poll.
Yeah, let's take a look at the poll, see what everybody thinks.
I think people filled that out before I went through my market vision, so hopefully I didn't influence people. So this is why we're so into education, because people are cautious. They're really fearful if you look at the market action based on that CNN index. And caution is always good, but there's also opportunity in corrections and pullbacks, and we like to focus on the opportunities unless we're really convinced that it's a bear market, and they don't come along but once every 4 or 5 years.
Yeah, I know one thing that we like to go over a lot on the show, we look at the VIX, the volatility index, and the VXN for the NASDAQ 100. And, I've pointed out on here many times that when you get those panicked readings, those high levels of the VIX and the VXN, if you go back in history, and history is a great educator, you go back and you look at the major bottoms in the market, they always coincide with these huge spikes in volatility. And we saw that. I mean, we saw it recently. You were talking about it a lot during your presentation, the fear that's out there in the market and everybody being so bearish. And I think that's one way for everybody easily to follow it on stock charts, is just simply watch the VIX and the VXN. When you get those big spikes, many times you're at or near a very significant bottom.
Well, and actually, sorry, Erin, go ahead.
I was going to say, we do, I do cover the sentiment, every week. And I think it was last week or the week before, NAME, the National Association of Active Investment Managers, reported their lowest exposure.
35% down from 100% 4 months earlier.
Yeah. So there's some fear.
Yeah, I think that's a really good sentiment indicator. I just wanted to point out that there's something called contango in the futures market. It's when the near-term VIX contract or any futures contract is actually trading higher than the further out contract. At the same time you were spiking, you had contango, meaning there was real fear again in the market.
Mm-hmm.
Oh, interesting perspectives. I like it.
All right. Well, always a great time when you come on the show, Mark, and we look forward to having you back again. And I agree with you on your assessment of Dan. You're working with a very sharp individual. He comes on the show quite often as well. And we always enjoy having our visits with Dan as well. But really want to thank you for taking your time out to help show everyone what you're thinking about when you look at the market.
My pleasure, and I look forward to the next time.
Excellent.
And there he goes.
Ooh.
Wow, that was a great presentation. I know we went a little longer today, but we wanted to go a little bit longer. That was a great presentation. And, you know, I think all of us need to take a deep breath sometimes. And yeah, it looks like we could be in a bear market, but there are obviously some opinions otherwise. And I know earlier, Mark was talking about Jeffrey Salt. We had Jeffrey on our show a few months ago, and I did see his, I didn't see the CNBC interview with him, but I did see a recap where he was suggesting that we are going to have a big 5-week rally into the end of the year. He believes that. He thinks we're going back up above 3,000 on the S&P 500 in a very short period of time. Getting off to a good start today. I don't know if it holds, but we'll see.
Yeah, well, it's what it sounded like Mark was saying at the beginning as well, that, you know, when the market does make its reversal, it's going to be really hard to get in because it'll go up so fast. You know, that's, I'm not there yet, but, you know.
Yeah. Well, one day that certainly doesn't make. And hey, when you're in a highly volatile market, who knows where we're going to be at 4 o'clock? I mean, I feel really good about what's going on so far today, but if we had a big reversal and finished back down near the flat line, which we've seen plenty of times, you know, and leave a long tail to the upside, that would certainly make me a lot more cautious in the near term. But I tend to side, you know, with what Mark was talking about. I do still believe we're in a correction, but the rallies have been different this time than what we've seen, what we saw back in February. So I'm still cautious.
That's what worries me.
Yeah.
You know, just the leadership like we were talking about, but oh my goodness, we better get going. We could just chit chat here forever. All right. Let's see. We do have the 10 and 10. We'll just either go all the way through it quickly, or if you want, we'll just do a couple of them. We had about 24 requests, and the first one that we're going to look at is CRE.
All right, we're going to go through, probably won't get through 10, but we'll try to go through a few of these pretty quickly. CRE, you can see, I think there's a change of character here. I think it started with that huge volume move back in the middle part of October, reversing this downtrend. We clearly have an uptrend. Look what the semis have been doing, going down while CRE has been rallying. And what that has created is a relative strength picture now where CRE is outperforming its semiconductor peers, and it is now at a 52-week relative high versus its peers. So I think that there's been a positive character change here. I love the fact that it pulled back, bounced off that 20-day moving average and gap support, and is now going back up to new highs. I don't like to chase, but I kind of, you know, agree with what Mark was talking about earlier. I think if you get a pullback in the stock, get closer to maybe that 20-day moving average, I think that would be a time to consider entering.
All right. Excellent. Most popular, we actually have a tie, so let's look at both of them. INTC, Intel.
All right, let's stick with the semiconductors. Intel. Now, Intel is still trying to get through some overhead resistance. And even today, with the market so bullish, it struggled at this area around $49 where it's had some issues. On a relative basis, it too is moving up. So we've seen semiconductors really moving down, putting in this double bottom. And you can see really with this double bottom, look at what Intel did. Intel never went anywhere near its October low. So I think that is telling us things are starting to turn on Intel, but I would like to see a breakout. So for annotation purposes, I'm simply going to draw this line in around 49. Let's get that breakout above 49, see a little volume coming in, and then I think that'll confirm what the market is already showing us in terms of relative strength.
All right, the other one that was in the most popular group, Apple.
All right, Apple. I think most everybody's heard of these companies. Yeah, Apple, of course, computer hardware has been getting hit because Apple's been getting hit. If you look at the chart, Apple's such a huge company. It's a massive, major component of computer hardware. But still, relative to the computer hardware group, it has been declining here in the month of November. So, yeah, we're getting a bounce, but this is a pretty muted bounce considering how oversold we were and what the market is doing today. So I got some issues here with Apple. I think as far as maybe looking at a key area in terms of price action, and long term, I love Apple. I just think in the short term, I mean, we made a huge run on Apple. This chart only goes back to the beginning of the year, whatever. It doesn't really show how much the stock has run over the past several years. But I think we've got gap resistance and the declining 20-day moving average. I think those are the two levels to watch to the upside.
All right. Let's go ahead and look at Granger, GWWW.
Yeah, this was a stock that was looking great until August. And then it started to drift lower with its group and then finally just kind of fell apart. And notice that reversing candle at the 50-day and also at gap resistance. We've got to negotiate that before we can get through. Now, this is a stock that had run up quite a bit. I'm very familiar with it because it did come out with some great earnings reports. You can see all these gaps higher. And then the last one was down. So it seems like it started to reverse and is going the other way. But there was your gap down right here. That was where we were before the gap. And look at where we reversed, right at that 315 area. So I think until we can get through the 50-day moving average and this gap resistance, I would be more on the bearish side here with Granger. Even today with the market rolling up only about, 0.63%. Not a very strong move. I think that this is one I would probably be steering clear of until it can start to show not only breakout, but start to show relative strength again.
Okay, let's see. Next one. Excuse me. Let's do here. HEAR, Turtle Beach.
Yeah, this was a company that was leading for a long time, and I was trying to catch a bottom on it, got stopped out, but it is beginning to roll again back to the upside. The problem was for me that it didn't turn where I thought it might. You had some prior lows in October, and then you also had this pretty important low. This was the reaction low after a huge move up back in May, which was around 15, and we ended up going below that. If there was one positive, it's that as it moved below 15, you can see the volume wasn't very strong. And now it's starting to rally back up. It's gotten through its 20-day moving average. It needs some volume on the upside here. But in terms of annotating, I think the next thing that's going to have to try to do is just break this downtrend. It has been trending lower for quite some time. And so I'm just going to draw this line there and then drag this down. I think you can see that there's a pretty well-defined channel that the stock has now been in since the beginning of August. Yes, we're moving up, but volume is light. Can we get through this upper end of the channel? I don't know. We'll see.
Okay. Our only healthcare request, HCA.
All right. I think I will make this one the last one so that we can get a market update in and then do a final abbreviated segment on scooters. Okay, HCA. First of all, I think this group, the healthcare providers, look at it, trying to make a breakout. What other areas in the market are making breakouts? I mean, restaurants, maybe a couple others, but not too many have been breaking out with the market so weak over the past couple months. Healthcare providers continues to be one of the strongest areas within the healthcare sector, and this is one of the better stocks. And again, this is what I like to look for, a stock that from the left side of your screen to the right side of the screen is going up on an absolute basis. It's going up. Its group is going up on an absolute basis, and then relative strength among its peers is rising versus the S&P is rising, and the group relative to the S&P is rising. It's hard to lose money in stocks like this. I mean, I'm not saying you can't lose money because you can, but if as long as this pattern continues, this is a stock that will continue to outperform the S&P 500. So I like it. As far as the annotations go, I would just simply say in the very near term, you've got overhead resistance that we're approaching near 145, the recent low down around 133. That's the trading range I'd look at, but I would expect to break out to the upside. I think this is a nice looking stock.
Okay, that completes our, 5 and 6, 6 and 6. There are the symbols. I'll have all of these up in our Market Watchers Live chart list. Just go to the blogs tab, click on the Market Watchers Live blog, and the link is right there at the top. All right. Let's go ahead and get into the final market update. Really interesting 10-minute bar charts here. All right, here we go. As you can see with when we got the word from what happened with the Fed and Powell and what he was talking about, the market's clearly happy about that. You can see that the Dow is now up over 436 points. And the S&P 500 is also on a nice tear to the upside, up almost 1.5% right now at 2718.90. The NASDAQ is also flying up there. We can see that it's up almost, well, actually it's up over 1.75% now. I look at my screen. Mid caps also having a good day. You can see a nice move off of that intraday low in negative territory. Now making quite the move, has definitely outdone what we saw on Monday's intraday highs. Russell 2000 also taking off nicely. It is up 1.75%. Treasury yields higher at right here. Treasury yields slightly higher. Actually, they're unchanged currently at 3.055%. VIX is moving lower. Not a surprise with the market starting to rise. Currently reading at 1892. Gold. Look at the dollar and gold. Wow, big moves on the Fed news. And USO down. It had managed to get to positive territory, but lower, and bonds spending their time in negative territory, sitting near their intraday low, currently down 50 cents TLT to 114.52. That's all I got, Tom. Let's do it.
All right, just quick, just want to show the home building group real quick. And again, new home sales came in very, very weak today. And we saw for many, many months, and especially September and October, as some of those bad reports were coming out in housing, the group just could not catch a bid, and it just kept selling off. And recently I've talked about how some of the bad news has been accepted. And in fact, the group has been rising throughout some of this. Check out the volume here is coming off the bottom. And look at today, after the stock or this group was down significantly with the poor new home sales report. Look at where we are now. We've reversed up. We're actually up 1% with a new home sales report that came in, I don't know, 4 or 5% below expectations. That would not have happened a few months ago. So I think a lot of bad news is baked in. And when I look at that weekly chart, it's happening. This bottom is happening at a major long-term support level. Next big technical area of resistance is going to be that declining 20-week moving average that we've struggled with throughout 2018. A break above that, I think, signals that a bottom is in on home construction. So I think this chart's looking very good. And I circled that volume down there. I think there's a lot of accumulation taking place as folks have been selling on a lot of this bad news the past couple of months.
Mm-hmm. All right. Excellent. Do you want to start scooters, or would you like me to do that?
Go right ahead. We've got about 8 minutes. So
all right. I'll do this very quickly. I'll take my 4. You can have your 4. All right. I was going to look at pretty much the top 10 technical rankings. So this is the StockCharts Technical Rank scooter, as we call it. If you go to your member homepage, you can actually set up a tile with the scooters in it. And we also can look at what we have for large, mid, small caps, ETFs. As you can see, lots of choices. So I'm going to start with the large cap and show you a few things you can do. These are the top 10, obviously the highest scooter ranks listed right here. And not a surprise to see some of these large cap names, McCormick up there at the top, and Advanced Auto Parts. Interesting list for the large cap scooters in the top 10. One thing you can do is do an RRG, or you can do a candle glance. Let's just look at the RRG very quickly here. This is the top 10. Right? These were the ones with the best scooter rank. Not a surprise, is it, to see them all in the leading category, moving in the right direction. Even HCA and Advanced Auto Parts, they're moving upward now into the northeast direction, even though they had been leaving that leading category. So I think that's very interesting. You could see how the RRG does match up very well with our scooters and how we look at the market that way. All right, let's look at this is the low 10. So what would we expect on the RRG? Yes, exactly the opposite. The only interesting one I would say is maybe JD, because it is starting to move upward toward the improving category. So that might be one that I would look at. And if I just hover over the chart right here, you can get what's going on. And an interesting chart, I would say, let's take a peek at JD.com. I say interesting because it looked like we had kind of a short-term, we're in a short-term rising trend here. We covered up a gap lower. The interesting thing for me is I would be watching that 2150 level. You know, you can see it in the thumbnail as pretty good resistance, but if you start looking at it down here as well, you can see that that 2150, $22 even is going to cause some overhead resistance. The PMO is turning up. So although this was sitting on the bottom 10 of our scooter ranks, we still saw that it was starting to show a little bit of improvement, at least on the price chart. We can also go ahead and do it as well for our top up and top down. So today, these are the highest scooter movers in the large caps. And right now, OGZPY is leading. Looks like a, let's see, a lower price stock here. I can just click on that. So you can see we've got its move. Here's that scooter move for today, moving it back up above that 75 line into the hot zone. PMO has just got a buy signal. Of course, not a surprise when you see two big gaps up as far as a rally off of that low that we saw a couple days ago. So I thought that one looked a little bit interesting just because it was sitting at the top. Back here. There we go. All right, now I'm going to look at the candle glance because you can do that as well. And I'm doing this for the top up, and then I'm going to pass it back to you, Tom. But what I do is I like to look at it in my candle glance style. And I can see what's going on with the PMO. I can also see what's going on with price action. And I can see what's going on with the 20, 50, and 200-day EMAs. And so I can look for the types of setups that I normally want. For example, look at this, Infosys, INFY. I'm seeing a double bottom here. I'm seeing a big gap up and a possible execution of a double bottom. As you can see, the confirmation line is right here at about that a little bit less than 970. And we have managed to get above it. Of course, this is a 5.5% rise, so you may want to wait for just a little bit of a pullback to that confirmation area, but looking good. So that's all I wanted to show, Tom. Just some of the ways that I use the scooters on the front page and my candle glance and the RRG.
All right, I'll take a quick look, and I'm going to follow up on some of these home builders that I was just talking about and I'll show you how you can take a look at these on it from a scooter perspective. So let me start and just show you from the home page what you do. So I showed earlier how I think home construction could be putting in this bottom. We may be ready to rally. It's possible we go back down one more time, test the lows, but if the market goes higher, I'm not sure that this is a group that's going back down. So what I would do is come in here once I have a thought of which area of the market I'm interested in. If you go into the scooter reports here and click on it, and then you've got the large cap, you can come over and search quickly if you know what you're looking for. Home construction, there are 3 large cap stocks here listed. Let's take a look first at Pulte. This has only got a 41 scooter rank. So these are stocks, I mean, the whole group has been bludgeoned in 2018. So you really wouldn't expect high scooter ranks. But among the large cap, this is one of the better ones. And you can see coming off that bottom, really strong move, beautiful push up. These moves below the 20-day both had hollow candles. Here was a third one. Look at this move back to the upside. And now we're strengthening with a rising 20-day, which is now above the 50-day and continuing to pull away from it. So I think Pulte certainly is one that looks kind of interesting to me. Let's see. DR Horton is another. I think longer term, DR Horton's pretty nice looking chart. But here, almost like an exhaustive kind of move to the downside. You can see the volume pick up on the most recent lows. And now we've got this nice uptrend. Looked like we were breaking back below the 20 earlier, but we're now strengthening. I think DHI looks interesting as well. Moving on to the mid cap. The only one I thought, well, first of all, these two over here, the first and the third one, don't really have a lot of volume. So NVR and then this Lennar B share. But let's take a look at Toll Brothers. Toll Brothers, you can see, again, went down below the 20 and the 50, came back up above. just looks to me like these stocks have put in bottoms. Notice also the 20-day getting ready to cross above the 50 on Toll Brothers. Finally, let's look at the small caps. The two that I want to focus on here, the highest scooter. This is the highest scooter of all home construction stocks among large, mid-size, and small caps. Let's take a look at the chart. Well, it's well off the bottom, so that certainly is helping. Its short-term rate of change is going to be much stronger because it has been rising. But here it got down to 25. I think a breakout above 30 on MDC would be extremely positive. And when you look back over the last 6 months and you see that its high was up around 32.5, 33, and this stock's almost at 30, clearly it is a significant outperformer versus its group. I don't even have to look at the relative chart. And then the last one that I wanted to look at was Beazer, only because that I know they're on my strong earnings chart list. I think this was a change in character, huge downtrend. Look at the volume coming in on this candle. We went back, we tested. If you watched the gap trading I talked about yesterday, tested the top of this gap support and this tail, and look at where it is 7 days later, right back near these highs. I think Beazer has changed and is starting to make a move to the upside as well. So those were the stocks that I had for the scooter report. So again, Erin is showing you one way to take a look at it on the scooters. I show you another. So many things that you can do with stock charts. Very, very powerful platform. And hopefully you all experiment in addition to following what we do. There's so many different ways that you can use the scooter. Scanning with scooters would be another amazing feature. If you're looking for, say, stocks that had a scooter rank below 50, say a month ago, and now above 90, or maybe below 30 and now above 70, just give you an idea of some of these stocks that have changed their character. And I know earlier Marc Chaikin talked a lot about that, where these stocks go from underperformers to outperformers. Using the scooter would be another perfect way to identify some of these. So, okay, what a day.
I know. Excellent. What a great show. I had a really good time today.
Yeah, and right now we got the Dow Jones Industrial Average up 481 points. I can show you the what we're looking at. I don't know if you can see this or not. Can
there
you
see go. It?
Yeah, I mean, but you can see the Dow currently sitting up near the high of the day. This is one of those trend days that talk about from time to time where it starts up early in the day and then just continues going. I think these are very, very bullish types of days, assuming that it continues into the close. But it's not just the Dow. I mean, we pull up the NASDAQ. You can see it here. The S&P, remember we were talking about 2680 to 2690 on the hourly chart when the Fed came out. And, Mark was indicating this could be one of those reasons to really get the market going. From that level, as soon as that speech, came into play and we saw what Fed Chairman Powell had to say, we had a huge move to the upside. So the S&P breaking above key short-term resistance. You can see the Russell 2000, which was down earlier, has had a huge rally back up and is now challenging the NASDAQ, for the top spot. So all in all, pretty bullish day considering, where we've been.
Where we started, honestly. When we started the show, it wasn't quite so exciting.
No, it was not. In fact, I'm actually in the IWM that tracks the Russell 2000. When I saw this morning, while the rest of the market was up, I mean, you can see below the dotted line, it goes into negative territory. If you pull up the S&P 500, you can see that we never went below. So on a relative basis, small caps were underperforming. And that's been part of the problem with the market is small caps have not really performed very well. So
yeah, they have to get on board.
Yep. And I think they are, or at least they're trying to today with this huge rally off that earlier low. So we'll see if it continues. All right. Well, it was another great session, another great show. Always a pleasure having Mark on here along with Dan. They offer up such great information for us and just makes sense. And it kind of fits my style. I like the pullbacks and getting in on these strong stocks. But anyhow, I want to thank all of you for being with us today as well. Please remember to complete the survey as you exit. We do love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. We'll see you back here tomorrow. Happy trading.